gold's case, it's not gold going higher. It reflects the loss of purchasing power of the currency. This is why when people say, how high can gold go? The answer is, how low can the dollar go? Franz Pick used to say all currencies, fiat, are inherently meant to die. In essence, it could go to infinity. Now, I'm not saying that's going to happen, obviously, but, you know, I just think that people could benefit from diversifying more heavily into gold and silver like the central banks have. Goldman Sachs sees the scope for prices to move well beyond 4,000 as their baseline forecast for next year, and even beyond the 4,500 tail risk scenario. This is, again, no public participation, but if 1% puts their money in of privately owned U.S. treasuries, they're saying 5,000 an ounce. Yeah, no one really is talking about it, which is kind of crazy. And, you know, look, I think it's most important to understand that this is not gold going up. It's mostly currencies everywhere depreciating against gold, not just the dollar, but all currencies. And I don't know, it's not only a normal bull market, which I see very clearly, but it's also a monetary system reset, which I see very clearly. And, you know, when you see an environment where foreign governments and central banks hold more gold than U.S. treasuries, it's a sign that they trust gold more than they do the dollar and our debt. This is a big deal. This is a monetary reset. This is a reshuffling of the deck. I think people need to understand that. It's crazy that this isn't all over the mainstream, that this isn't spoken about. It's shocking to me, and it just makes my disdain for the legacy media grow by the day. You know, look, our massive debt means that we will almost certainly rely on money printing to pay it back, which erodes the value of the dollar. Foreign holders of our treasuries and our dollars do not want inflated dollars, so they too are shifting into gold. And it's because of the credibility, the liquidity, the physical security. This is what has shifted gold's bull run from 1,700 to 3,500 an ounce in just the last 3 years.
The United States' massive and rising debt virtually ensures more money printing in the years ahead. Such policies devalue the dollar, leaving foreign investors holding depreciating assets. In response, many governments are turning to gold, valued for its credibility, liquidity, and enduring stability. This accumulation has fueled gold's surge from $1,700 to over $3,500 an ounce in recent years. Meanwhile, leaders like Xi, Putin, and Modi are promoting trade in local currencies, a move that reduces reliance on the dollar. The world is shifting toward multipolar trade systems, with gold positioned as the ultimate hedge against this transformation.
And then at the same time, you got momentum building with guys like Putin and Xi and Modi, who are openly urging trade in local currencies, which again are laying the groundwork for a world less dependent on the dollar, done again. And that's, you know, this is what it is. It's not so much gold, it's the dollar, it's everything. Gold is the barometer by which we measure everything else. And when you have a treasury that is projecting well north of 22 to 25 trillion in debt in the next several years, with our foreign creditors who have supported our lifestyle backing away, I mean, I don't know, isn't it always been the Fed that stepped in and with more money printing, risking inflation? I don't think this is panic. This is a sober reality. Confidence in the dollar is slipping, and gold and silver, with its long-term 5,000-year track record, speaking of 5,000, that's the number that we're getting out of Goldman Sachs if just 1% of the money that's in treasuries pulls out of treasuries. Bald Guy Money did an interesting one, and he said if 20% pulled out, he was getting $9,000 gold. And it wouldn't surprise me. And then they revalue it. The higher the price of gold goes, only benefits this country on many levels, not only through the devaluing of the dollar, but also, of course, the ability to, if Judy Shelton is right, peg gold to the back end of the treasury. You know, this will probably I doubt people would get this, maybe people watching your show, but if you bought, what do you think was the best performing asset if you bought the day Nixon closed the gold window on August 15th, 1971? Well, obviously I'm asking the wrong crowd, but number one was gold, number two was the S&P 500, number three was the Dow Jones, number four was silver. And this is including reinvesting every dividend for compounding gains, which no one ever does. Investors never do that. But if you had invested every single dividend for the past 54 years, gold is still outpaced the Dow and the S&P. Silver came in just behind those at number four, but it goes to show the old adage that Wall Street wants us to believe that because there is no yield on gold, you should have known it. It's actually a joke.
Gold does not simply rise, it exposes the dollar's decline. U.S. debt projections topping $25 trillion threaten the trust of foreign creditors who once supported America's financial dominance. History shows gold consistently outpaces traditional investments over long stretches. Since the closure of the gold window in 1971, gold has outperformed the S&P 500 and Dow when adjusted for reinvested dividends. This challenges the long-standing narrative that gold has no yield. In truth, gold's yield lies in preserving purchasing power. As investors measure assets in gold rather than dollars, a clear reality emerges. Paper currencies consistently lose value.
Just about anything that you measure it against, in all valuations, don't measure it against the dollar, measure it against gold, and you'll see that in terms of gold, things are getting cheaper. And I expect that the price of gold only goes higher because, as Michael Oliver, who you have on your show all the time, he's talking about a real massive capital rotation from Western mainstream legacy investment stocks, bonds, etc., into precious metals. He says this happens but once only every 50 years. Doing a little bit of reading this weekend, found it very interesting that before Scott Bessent became the U.S. Treasury, he wrote this. I'm going to read it from his January 2024 Key Square Capital Management letter. And then I want you to think about where we are right now today and his role in all of this. We believe that this, and again, he was writing this for a letter. He was a capital management letter that he was working for in 2024. We believe that this inappropriately easy policy, monetary policy they're talking about, inflated the dot-com equity bubble. Our best case is that a re-elected Donald Trump will want to create an economic Lollapalooza and engineer what he will likely call the greatest 4 years in American history. In this scenario, here's the important part. The greatest risk factor, in our opinion, would be a sudden rise in long end rates. I find it interesting. I think this explains why he's so much into gold, and this is where we're going. This is the path that we are heading on. I also found it interesting that Bessent just also advocated for a comprehensive independent review of the Federal Reserve. He called for scrutiny of the entire operation, its monetary policy, its regulation, its staffing, its communications, blah, blah, blah.
Market analysts warn of a massive capital shift, one seen perhaps once every half-century, away from traditional Western assets like stocks and bonds and toward precious metals. Even insiders, such as former hedge fund executives now in U.S. Treasury positions, acknowledge that overly loose monetary policy has distorted markets. Rising long-term rates could destabilize debt markets, further boosting gold demand. At the same time, political efforts to influence the Federal Reserve risk eroding its independence, threatening its credibility worldwide. Goldman Sachs projects gold could reach $5,000 under such conditions, not because gold is stronger, but because the dollar is weaker.
He argues that the Fed has strayed beyond its mandate and needs to regain credibility as a non-political institution. He said that the Fed should relinquish its banking supervision duties and limit economic intervention, particularly unwarranted bond purchases outside of crises. But this aligns with President Trump's effort to increase influence over the Fed. So if that happens, you look at Stephen Mirren being put in and Trump's attempt to sever the independence, if you will. Isn't that exactly what Goldman Sachs was warning about? That the political control harms its credibility, increases inflation, undermines its trust. Bang, gold goes to 5,000. So it's happening right now. I mean, you can see it as being undermined. And so, I think that one should expect gold to go much higher in the face of a dollar going much lower and the Federal Reserve losing independence, as Goldman Sachs has so eloquently spoke of. Gold's case, it's not gold going higher. It reflects the loss of purchasing power of the currency. This is why when people say, how high can gold go? The answer is, how low can the dollar go? Franz Pick used to say all currencies, fiat, are inherently meant to die. In essence, it could go to infinity. Now, I'm not saying that's going to happen, obviously, but, I just think that people could benefit from diversifying more heavily into gold and silver like the central banks have. Goldman Sachs sees the scope for prices to move well beyond 4,000 as their baseline forecast for next year, and even beyond the 4,500 tail risk scenario. This is, again, no public participation, but if 1% puts their money in of privately owned U.S. treasuries, they're saying 5,000 an ounce.
Recent U.S. job reports reveal troubling patterns. Full-time employment is shrinking while part-time work expands, forcing many Americans into multiple jobs. These economic pressures weaken confidence in official data and expose deeper vulnerabilities. On the global stage, alliances are shifting. India and China are strengthening ties through the Shanghai Cooperation Organization, building financial structures to rival the dollar-dominated system. Meanwhile, BRICS nations accelerate the creation of alternative banks and payment systems. For countries like India, discounted Russian oil is more vital than U.S. trade, underscoring the gradual realignment of economic priorities away from Washington's influence.
So, I don't know. But I just want to hammer it home. If Trump lowers yields by 2 or 3% real yields, it'll be negative. Even by their numbers, big money will not stand for that. That's why they are front-running this. The world's largest players, the central banks, the global lenders, the corporations, the global lenders being the commercial banks, the ultra-wealthy, they've all been quietly repositioning. But once it becomes obvious that the public will realize that fiat money is eroding, is it too late at that point? I don't know. I'll leave that up to everyone else. A couple last things here. The jobs report. The consensus was that between 40 and 100,000 jobs would largely greenlight a 25 basis point rate cut. But we would need a massive, massive outlier for the Fed to cut by 50 basis points. Well, we got that outlier. The BLS reported that in August we only added 22,000 jobs, not the 79,000 jobs that were expected. But more importantly, June was revised from 27,000 to negative 13,000. It's the first negative print since 2020. They keep revising these jobs numbers. Remember what happened with July and August, those numbers. To the ugliest part, in my opinion, of the jobs report was the number of full-time jobs. They fell by 357,000 jobs. It's the second consecutive month of full-time job losses, while part-time jobs surged by 597,000. So you lost 357,000 full-time benefit-paying jobs and you added 597,000 part-time. Kind of seems like people are working 2 or 3 jobs to make ends meet. It gets worse. The number of native-born workers fell by 561,000 to 132.474 million. This was the biggest drop in quite some time. At the same time, foreign-born workers increased by 50,000. the number of multiple job holders soared by over 443,000 to 8.785 million. This was the biggest monthly increase since COVID, and another indication of how stupid the jobs report in the Bureau of Labor Statistics. We should just pull the L out of it, and it should be called the BS. They continue to do this stuff. Now,
America's regional banks face mounting stress as deposits flow toward digital platforms and stablecoins offering higher yields. This transition undermines the traditional banking model and may accelerate the concentration of capital into too-big-to-fail institutions. If one mid-sized bank falters, the domino effect could be severe. Meanwhile, fintech and stablecoin ecosystems expand, backed by U.S. treasuries but outside traditional regulatory frameworks. Combined with global debt, political uncertainty, and diminishing faith in fiat currencies, the trajectory is clear. Gold and silver remain the ultimate stores of value, while the dollar's dominance faces its most serious challenge in decades.
next week, I think, is it next week? I think it is. They are supposed to revise job growth figures from early 2024 through early 2025. Forecasters have thought that job growth would be slower than previously thought. Now you're getting analysts saying revisions anywhere from 475,000 to 1 million jobs will be revised out. Originally the number was 1.76 million. They're talking about revising 1 million out of the 1.76. I think, let's see, I got maybe 2 or 3 more things left to say. I found it interesting that Trump says that the United States has lost India and Russia to China. And he said, may they have a long and prosperous future together. That's what he came out and said that. And maybe that's because both India and China confirmed to boost their ties to reduce the effect of Trump tariffs at the Shanghai Cooperation meeting. Moody called for stronger relations between the Asian neighbors to minimize the impact of the decisions made by the U.S. without naming Trump. Modi on several occasions called out the West for selfish decisions and vowed that India would never compromise on the requirements of its people, especially their farmers. Not sure what that's all about. I did find it interesting that in an official statement later in the evening said that the SCO had decided to establish a development bank and accelerate consultations on a series of issues related to the financial institution's operation. In other words, this is going to be connected also hand in hand with the BRICS New Development Bank. Now you have the Shanghai Cooperation New Development Bank. Remember, I always said that these would merge, SCO and BRICS. They're going to merge. They have the same goals and largely many of the same participants. India has more to lose by ending its purchase of Russian oil than it does if it stopped trading with the United States. Even though we're their largest trading partner, it amounts to less than 2% of their GDP. 1.9%. I think we're getting to the end. And that is it with the exception of one other thing. We're seeing insured deposits shrink out of the banks. In particular, the regional banks and the small banks. And a lot of money is finding competition with digital banks and stable coins. And wait till you see what happens with all of these stable coins, with fintechs and stable coins offering higher yields and lower fees and instant transfers because they don't have brick and mortar, and they don't have ATMs and all this stuff. We're not out of the woods yet with the banks. And the more we start moving towards this digital system of stable coins, you're going to massively erode the stickiness of bank deposits, and which has been the foundation of bank stability. If the Fed cuts rates, banks are going to earn less from lending, but still need to pay competitive deposit rates, which squeezes the margins and makes the weaker regional banks more vulnerable. Think of Bank of Lindsay, Oklahoma. I don't know. I think that the end of the banking issue is not behind us. If one major institution cracks in confidence, the fallout could be severe because you're going to see a greater concentration of money move out of the small and regional banks, both into the too big to fail banks, like we've always talked about. This is what they want. And also into a handful of these fintech institutions, which again will all be one-to-one backed by U.S. dollars and treasuries. And that is all I got. Happy to answer any questions or any comments. And I made it easy for you today.